Hi guys, and welcome to another week ahead video. Now in this week's video, our focus will be on the Canadian dollar. We saw some crazy price moves in terms of oil prices over the last couple of days. Very interesting events happening between the US and Saudi and Russia. Even some interesting events happening on Friday late in the US session, as well as on yesterday on Saturday. So a couple of things for us to look out for that very anticipated OPEC Plus meetings occurring next week. Join us now to the video to see exactly how we can prepare for these events and hopefully trade them in this upcoming week as well. Okay, then looking at the baseline for the Canadian dollar. Now, the fundamental outlook for the currency has become increasingly bleak over the last couple of weeks. We had the BOC cutting rates down to 0.25%, as well as the BOC starting their very first quantitative easing program. We also saw lots of downside in the high beta commodity-linked currencies like the Aussie, the CAD, and the Kiwi, due to the overall negative risk tones we saw in the market from February due to the outbreak of the coronavirus. However, the biggest headwind for the CAD was the big plunge we saw in oil prices, with WTI and Brent crude reaching its lowest levels in nearly 2 decades. Now, this chart on the left-hand side shows the almost 12% drop we saw in the Canadian dollar index from the start of January, as well as alongside that, the big drop we saw in WTI as well. Now, the big drop in oil came from two sides. Firstly, we had a big slowdown in oil demand due to the coronavirus globally. We also had a price war between Saudi and Arabia that started, which also saw big drops in terms of oil prices. Now, the events from this week did see some relief on oil prices as well as the CAD when President Trump announced that he expects oil output to be cut by 10 to 15 million barrels per day after speaking to both Russia and Saudi Arabia. Now, to confirm this, Saudi did call for an emergency OPEC Plus meeting that would have taken place on Monday, the 6th of April. There was also talks that other non-OPEC members might be willing to participate in planned cuts in order to stabilize the oil markets. Also, Russia coming out saying that they might be willing to cut even more if US shale oil industry also came to the table to reduce output. Now, the good news gave markets hope that the planned emergency meeting could bring well-needed production cuts. As a result, saw oil prices rally almost 50% in this week and also supported the CAD as well. However, we had some further events coming up on Friday and Saturday that did complicate things slightly. On Saturday, there was an announcement that the OPEC Plus meeting that was scheduled for Monday has been rescheduled to Thursday, the 9th of April, due to a diplomatic row between Saudi and Russia. The two sides basically had a very heated rhetoric, with each one blaming the other for the price collapse. And according to OPEC Plus delegates, the two sides required more time for negotiations before the actual meeting took place. Now, to make matters even worse, after meeting with the US oil executives on Friday, President Trump put pressure on Russia and Saudi to find a solution by threatening tariffs if the two sides cannot reach an agreement. President Trump said that he will do whatever he has to in order to protect the tens of thousands of US energy workers, even if it means adding tariffs on oil coming from the outside. Now, how this relates back to Canada is very important. Remember that the reason for Canada's dependence on oil is not only due to oil contributing 14% of their total exports, but due to the big discount between WTI and Canadian crude prices. Sour and lower grades of crude oil often demand much more expensive refining, which is why Western Canadian Select crude, which is a lower grade of oil, trades at a very steep discount to something like WTI. Now, last week, for example, before we had that big jump in oil prices, Canadian heavy crude tumbled as low as $3.82 a barrel, basically a 77% price drop from the start of this year. Now, some popular oil companies in Canada has already stopped fully suspended oil sand operations due to that massive fall in oil prices. And according to Bloomberg, the Canadian energy industry will already need over 20 billion Canadian dollars in aid from the government due to that slowdown caused by the coronavirus, as well as that big drop in oil prices. Thus, it's very clear that the burden of carrying these lower prices is not very evenly distributed among oil producers, and this growing concern alongside the global risk of flow saw tremendous downside in Canada's TSX index. And apart from OPEC Plus, we also have the March labor report for Canada due on Thursday. According to Scotiabank, this event has the potential to surprise markets to the downside with a sizable margin. In a note to clients, Scotiabank basically reported that this report is likely to be ugly and quite possibly could shatter not only the prior all-time job loss record, but also far exceed the pace of US job losses during the month in proportionate terms. Now, currently the market is expecting a print of negative 350,000, but a very wide range with a minimum expectation of negative 900,000 and a maximum expectation of 0. Now, even though oil markets will be the biggest focus for the CAD, the jobs report should also be a key data point that we need to keep on our radars for the Canadian dollar in this upcoming week. Now, looking at some potential sentiment shifts, starting with the dovish sentiment shift. The biggest dovish reaction from the CAD this week would come from a couple of factors. Firstly, we would need to see a total breakdown in oil talks, which results in possible retaliatory tariffs from the US. That can also be accompanied by a bigger drop in Canadian employment and overall risk of turns. Now, some analysts currently suggest that almost 40% of the world is currently in lockdown with very little idea of how long it might continue. Now, this has led some to believe that the total estimated drop in oil demand could reach between 15 and 35 million barrels per day. Now, this means there is a real risk that an agreed deal of 10 million barrels per day might only provide a short-term sigh of relief, and that the overwhelming lack of demand still puts downward pressure on oil prices in the medium to long term. Thus, for some, the only positive for oil prices would be a pickup in demand, which will only happen once the virus has been contained and the world economy starts returning to normality. However, even once all the lockdowns have ended, the sheer size of the business closures around the globe might not see the quick recovery many economists are hoping for. Thus, for those taking a longer term approach, these are very important points to consider for the CAD, as it might mean more downside in the medium to longer term, even if we do see some short-term relief. Now, turning back to the short-term focus, the Saudis have argued that they will not be carrying the burden of production cuts alone, and have said they want the new proposed cut to be driven by global producers. This means the hurdle for coming up to an agreement is very high in this coming week, and any breakdown in talks could very easily see oil prices trade back below $20 per barrel. Then turning to possible hawkish sentiment shifts, the biggest hawkish reaction from the CAD this week would come again from a slew of activity. Firstly, from a confirmed oil production cut greater than the proposed 10 or 15 million barrels per day, also accompanied by a big beat in the employment data and overall positive risk turns. Now, for those of you who've been following our webinars for the past few weeks, you would know that we have been expecting the Trump administration at some time to step in if oil prices continued their march lower. Now, we did see that happen in this week. Now, the virus coupled with lower prices has created a very big storm of headwinds for the US shale industry, which is why analysts predict that between 25% and 40% of US producers will seek bankruptcy protection in the coming months. Now, apart from the threat to shale, the whole world's producers are feeling the pain as the space to keep oil is currently running out. According to Bloomberg, oil tanks, pipelines, rail cars, and shipping containers across the globe are filling very fast. Now, some analysts have argued that this is much less of a concern for somebody like Saudi Arabia, which should have ample storage space available compared back to 2016. However, with the kingdom currently ramping up production to 12 million barrels per day, and analysts calling for between 15 and 35 million barrels per day of less demand, those spaces should fill up very quickly, even for Saudi. Thus, reaching an agreement is basically in everybody's interest right now. Thus, with the pressure of limited storage space, the growing lack of demand, as well as the possibility of retaliatory tariffs from the US, we do think that the odds are currently shifted towards a deal this week. However, a deal will only be viewed as a positive for the Canadian dollar if the total production cuts are above 10 million barrels per day. And even though a cut above 10 million would not fix everything, it should be enough to provide a floor, at least for oil prices, which should provide some solace for the Canadian dollar in the short term. Now, looking at some potential ways we can trade the CAD, in the case of a dovish sentiment shift, we could look to pair the CAD against the yen, which should remain well supported in the current overall risk environment. However, as risk sentiment can change from session to session, it'll be very important to evaluate the risk zone before taking any trades in the yen. Now, in case of a hawkish sentiment shift, we could look for to pair the CAD against the euro, which should remain well pressured, as both the sentiment and fundamental outlook is currently skewed to the downside. Remember that these recommendations are based on the current fundamental bias for these currencies at the time of writing and can change throughout the week, so make sure to reevaluate whether the short-term sentiment is still valid for these currencies before taking any trades. Now, looking at possible economic events that we can trade into in line with the CAD, with that short-term sentiment bias in the CAD largely being driven by developments in the oil market and risk sentiment, we would not be interested in selling or buying the Canadian dollar into the upcoming OPEC Plus meeting or the employment report on Thursday. We would want to see how these events play out throughout the week before we take any trades on the CAD.